Hey everybody, Chuck Barone. Wednesday, April the 12th, 2023. It's basic CPI day today, guys. We knew this day was coming, and boy, did it bring a lot of action in these markets. But before we start, as always, we want to welcome you guys to the show. Thank you guys for your support. We really appreciate you guys watching the videos and all you guys do every day. Markets today. Well, as we know, CPI came today, and unfortunately, as big of news as it wasn't the main driver of this market today. So the market started out, looked like we're going to have a decent day because CPI looked reasonable, I guess. But a wild day, swings all over the place, up, down, back down, finishing down today. The Dow losing 38 points, 33,646. S&P down 16, 4,091. The NASDAQ down 102, breaking under 12,000 at 11,929. Not a great day for stocks today, and we'll get into why in the comments. Another weird day in the bond market too today. You know, you would think with the inflation number coming in where it did, that rates probably would have spiked up. I think that the inflation number shows we're probably, I shouldn't say probably, likely to get another increase coming up on May the 3rd. But today, bond yields coming down a little bit. The 10-year down just 1 basis point at 3.42%. The 2-year dropping 9 basis points back under 4, 3.97%. So they just can't decide. And they can't make good news because they have to find another reason to make good news bad news. It's just, you know, these markets are what they are, guys. We deal with them how we do. If you've been following our advice to be invested very conservatively, you're probably doing good right now. You know, you're certainly not going to be affected by trying to be trading into these whipsawing prices and yields. That's certainly not a game for amateurs to be playing. You know, if you're a trader who's trading in these markets every day and you're online, you're in front of a screen every day, showing real-time prices and you're trading, that's one thing. If you're just your basic investor and you're trying to play these markets and try to time things or, you know, even making adjustments, trying to, again, time things. Okay, it looks like the recession's not going to be here. It looks like inflation's coming down. Maybe I can change my IRA around or my 401k. No. Conservative investment is what we want, guys. Play it cool right now. You know, this is not the time to be reaching for yield, although there is some yield to be had. But just be cautious. The dollar today down more than 0.5 point. 101.57 on the index. You know, the data that came in today, this recession fears, driving the dollar down. So as a result of that, metals had a pretty solid day today. Gold up $9.70, $2,013.40. Silver up 41 cents, $25.45. Guys, I'm telling you, there's going to come a day very soon where we're going to look at these prices and say, damn, it was a deal back then, we should have bought it. So if you've been waiting for prices to come down on metals, you know, you may have a dip or whatever there. Just make sure if that's the way you're playing it, you know, be ready when the dip comes, because I don't see any long-lasting real declines unless, of course, something cataclysmic happens and causes the dollar a giant rally, which is nowhere on the horizon, at least as far as I can see right now. Oil today, again, spiking up, another $1.73 per barrel. West Texas Intermediate, $83.26, which is disappointing to me. Oil had been trading down. There's as far as I've seen, there's no real reason for this spike. You know, OPEC's cuts, okay, they're already less than capacity anyway. There's less demand for their product. The cuts are going to be very marginal as far as price goes. But oil spiking up, which sucks because when it goes down, we don't really ever see much relief at the gas pump. But when it goes up like this for a few days in a row, we sure do see the prices spike up pretty quick. Bitcoin today, after a couple of big days rallying, down $331 today, $29,835, breaking back under the support line of 30,000. Round numbers tend to be support and resistance lines. So now it's going to be resistance getting back above 30,000. We'll see how Bitcoin does. I really think it's looking pretty strong right now in the face of a lot of negative news. And I've been encouraged by a lot of our viewers to learn more about it, and I intend to. Bitcoin holding its own, man, almost at $30,000. Now, news you guys need today. As we talked about prior to today, leading up to today, today is a huge day. The rest of this week is all big, but today is the day we were looking to C.P.I. data. The C.P.I. released this morning, 5:30. I was sitting in front of a Bloomberg terminal or a Bloomberg station, bleary-eyed. Top line coming in at 5%, down from 6% last month versus a 5.2% estimate. Pretty good result. Core coming in at 5.6%, in line with that's exactly what they expected. So the market celebrated these numbers. Inflation continuing to come down from its peaks. The Fed obviously doing these rates having the effect that they wanted them to have. With inflation numbers coming down, still some stuff that's touchy, services, eggs, and some basic essentials still high, but coming down as well. These numbers, though, still pretty high. And you're looking at 5%, and your target is 2%. Well, you're more than double what your target is. So I think that this keeps the pressure on the Fed to keep raising rates. As I've been saying, I really believe that there's going to be another increase coming on May the 3rd. That'll put the Fed funds rate up at 5.1%. I think that that's really where the Fed wants rates to be. I think it's a sensible rate in this environment. It's a rate that will get us above the rate of inflation, which is probably something that's going to be necessary to actually get the rate down closer to its target. So I think that this number, even though the market celebrated it for a few minutes at least, tells us that there's probably more hikes coming, especially if there's any surprises to the upside on inflation. Investors, however, now they got that news, they digested it for about 15 seconds, and now they start looking at other things, and what they're focusing on now are two big items. Bank data. Are they making loans? How are their loan portfolios performing? And profits. Are they making any money? Also, they're looking at the employment picture. Will it stay hot? Will wages continue to rise? And these are the things they're looking at right now for guidance going forward. Now, April the 14th, coming up here pretty quick. Today is the 12th, right? We're going to get earnings from J.P. Morgan, Citibank, and Wells Fargo. So this is going to give us an idea of where the major banks are as far as their lending. Are they continuing to lend? Have they tightened their standards? How are their portfolios performing? Are the banks making any money? Now, I'll tell you, the analysts are expecting that their earnings to fall 10% from where they were a year ago. So we'll see exactly how that all turns out. I think banks have been making money, not losing it. So it'll be interesting to see how Silicon Valley affects things, how these banks are they continuing to lend? I'm in mortgage. I haven't had a lot of demand for my product, but I haven't really seen with my own eyes a lot of real tightening in the markets, a lot as far as underwriting standards. They're taking a little bit closer look, but they haven't changed like you need a higher rate to qualify, or they haven't done any guideline changes. So they're kind of just keeping an eye on things, I think, right now. It's going to be fascinating to see all of this information. And of course, also on tomorrow, before Friday's banking information, tomorrow we're going to get our unemployment numbers. So we'll see where those come in. It's going to be really interesting because if those two are in alignment one way or the other, I think that's a pretty good indication of the way things could go. If they're in conflict with each other, which I would not be surprised to see, because that's what we've been getting for the last at least 6 months, is all kind of conflicting data, confusing the crap out of everybody. But I really believe, and still continue to believe, that we're going to see a 1/4 point increase in May, and from there on, and then we're going to be more data dependent There'll be a little bit less certainty about what the Fed's next move is. Now, the markets are pricing a 72% chance of a quarter-point rate hike on May the 3rd. So the markets believe the Fed will raise rates on the 3rd, 72% probability. This is, of course, would bring the Fed funds rate up over 5% to 5.1%. Now, at the same time, these very same markets, bearish in May, are showing a better than 50% chance of rate cuts by the end of the year. And they're expecting the Fed funds rate by the end of the year to be sitting at 4.5%. So they see a quarter-point increase coming here in May. And then they see between May and the end of the year, the Fed funds rate coming down 0.5 point, whether that's one rate cut or two. I'm not sure if I'm buying that. I guess it's going to depend on where the inflation numbers goes, the state of the economy. The FED minutes came out today. I know a lot of you guys are not big readers of those minutes, so let me give you an idea of some of the stuff that came in those minutes. I haven't had a chance to go through all of it yet, but here's what the Fed was saying. They see that the banking woes leading to a mild recession this year with recovery over 23 and 24. The Fed, this is really something, the Fed sees GDP growth in the United States this year at 0.4% for all of 2023. Now, right now, the Atlanta Fed GDP tracker, which has been astoundingly accurate, is showing plus 2.2% GDP for the first quarter. So to end up with a number at 0.4, it's going to show GDP declines, pretty significant ones, over the next couple of quarters to get to 0.4% at the end of the year. I don't know how that's going to fly. Now, they also see less tightness in the labor market. So they see the job openings falling and more unemployment. And they also see production lines loosening up, which will help bring inflation numbers, moderate inflation. Obviously, that's going to be probably part of the recession they're engineering anyway. But they're showing both of these things slowing sharply next year. Production down, employment down. The language they're using has changed. Originally, it was ongoing increases in rates. Today, it's as appropriate. I love these guys. So a lot of mystery right now, but one thing we can say with certainty, if you've been following the advice we've been giving you guys, saving as much of your income as you possibly can, not taking on new debt. If you can, even if $10 at a time, paying down existing debt, being thoughtful about the way you spend your money, trying to get away from the impulsive stuff. Buy what you need, buy what you want, but try to save right now rather than spend. Invest your money conservatively. Fear of loss should be number one on the list right now, and pretty much always. So if you've been following this advice we've been giving you since the very, very, very first show, you guys are hanging in there right now. You're doing okay, compared to the rest of the world at least. So anyway, guys, that's it for today. Tomorrow will be another monster day. We know we got huge data coming tomorrow. We know we got huge data coming on Friday. We'll be here to bring you guys all the gory details. It's Wednesday. Enjoy the rest of your day. Whew. Another crazy day tomorrow, guys. We love you. We appreciate your guys' support. Thanks for all you do for the show. We'll be back again tomorrow to bring you guys what you need to know. Until then, guys, take care. Thanks.